In today's world, the employer actually has to deal with three different entities generally for their workers' compensation. They have the BWC, the Bureau of Workers' Compensation, the ones that are actually making the decisions, and they're paying the indemnity. But the BWC, a number of years back, probably 20 years ago now, 30 years ago, switched over to an MCO model. So, Mr. Employer, not only do you have the BWC, but you have to choose an MCO who technically works for the Bureau. And so the MCO and the Bureau manage those claims for the under the state system.
Welcome to Insurance Shoptalk. This is the podcast where the world of commercial insurance gets a little closer to home. I'm your host, Eric Stein, and in every episode, we're taking a deep dive into the insurance industry. From the latest news and trends to in-depth interviews with InsurTech experts, carriers, and agency newsmakers, we're covering it all. So sit back, tune in, and let's start the conversation. All right, guys, I'm excited to have Bob Butts with us, the Chief Risk Officer for Alternative Comp Solutions out of Cincinnati, Ohio. Bob, thanks for being on.
Yeah, my pleasure. Great to be with you.
So the topic today that why I'm so excited is that for the first time, agents can actually sell workers' comp in Ohio and earn commission on it. That is similar to a standalone pay-as-you-go workers' comp product. It's not a PEO. And it's something brand new that was approved by Senate Bill 201 in Ohio, and then approved by the Ohio Bureau of Workers' Comp, the BWC. And ACS is leading the charge of working with agents in that channel to offer the product. So I definitely wanted to have Bob on, and we're at Insured Solutions been fortunate enough to handle the submission process for ACS, and had a great time with their CEO Todd Riley actually yesterday for the FedEx Cup. Bob, sorry you weren't here with us.
I don't get invited to the fun stuff.
Yeah, you're gonna feel better today than I, which is better than me. But so Bob, why don't you kind of go through a little bit about your background, because you have a strong history in workers' comp in Ohio, and then maybe a little bit about ACS.
Sure. Yeah, I've got you, but I'd like to back up just once and then make sure the agents that are listening, they're not actually selling workers' compensation. What they're going to be doing, what we are, is an AEO. And that's sort of different because workers' comp is still a monopolistic issue in Ohio. And what we're going to be talking about today is something to where it's a kind of an offshoot by allowing a self-insured entity to offer, other employers to jump onto our policy and as part of the suite of services that we offer them. So, but yeah, myself, I've been kind of doing Ohio workers' comp since 1989. And I've been working in the PEO, AEO area since the 95. I worked as a third-party administrator for almost 20 years until Todd Riley, who we were talking about, a buddy of mine, he and I kind of came up with a concept, and we went out and started a PEO, a very big one, and then eventually sold that off. And then a few years after that, all of a sudden, the House Bill 201 came along, which gave a new option, a new angle to the whole, game in Ohio. That he and I said, we think we can maybe make this go with this, and we started up ACS, Alternative Comp Solutions. It is a part of the Riley Decker family of companies, which is an area where we all, we have staffing, HR services, recruitment services, and the like. And so with ACS, we're able to round that out to more of all-round HR services, including payroll and HR administration, safety, FMLA, a little bit of the, some of the benefit areas, and then unemployment services and those kind of like. And so, we started it about 2 years ago. House Bill 201 is only about 3 years old, I think, at this point. And it's a rather new concept that's kind of popped up, and it's given an opportunity for a lot of mid-sized employers to really get a chance to control their work comp rates more securely than within the state system.
No, that's great. Yeah, so Bob, why don't you talk about and we were speaking earlier about this, that the beautiful thing about the AEO compared to the PEO is the client does not require to change their payroll system. They have to communicate with you with the payroll info as far as
Yeah,
access, so you can do the pay-as-you-go reporting forms, that the clients are used to and agents are used to selling.
right,
But the client, the big bugaboo with the PEO sometimes is that there's not enough time or desire for the client to want to switch the payroll around because it's such a pain in the neck for them. And agents
right,
don't like talking about it if they don't have to because it's just another step in the process. And they would rather
right.
be transactional and just get that work comp policy in place for the customer from a time saving point. So that's the big nice thing about the AEO. But why don't you describe the AEO and then the PEO?
Yeah, well, let's first go about why the AEO even came about.
Okay.
Okay, because that leads into the other stuff. But the AEO came about is because there was a group of employers out there that would look at a PEO and say, I like the services they're offering, but I just don't want to change my payroll. Why can't I have this suite of services without having to switch that payroll? And as I've gotten into the industry now for a while, it has always amazed me of how loyal and how strong employers are about their payroll system. Paying their employees is the number one issue and with them, and they want to make sure it works right. And so when they have something in place that's working, they don't want to mess with it. And the funniest thing in the world is we've brought deals, to employers instead of saying we're going to save you $200,000, but you got to change your payroll service, and they're like,
Mhm.
I don't want to do it because Betty Lou downstairs has been handling my payroll for 20 years, and she's swears by X, Y, and Z payroll companies. She doesn't want to move it. And so the AEO came about is because those employers that really don't want to do that missed out on other saving opportunities, that a PEO would offer. And so the AEO came about to change that. And so the AEO the difference is the employer keeps the payroll on their federal ID number. They don't have to change payroll companies, but we have to be engaged with the payroll vendor they're using. And we're engaged right now with like 17, I think about 17 different payroll companies that we work with, providing these services. ADP, Paycor, Paylocity, all the big ones are working with us. And so what that does is allow the employer still to have the ability to say, I like this platform or I like that platform, keep it, but yet still be able to come in and get the suite of services that we can offer. And that's been the big breakthrough that's allowed us to really kind of grow this and be able to really save a lot of employers money and help them become more efficient in their operations by giving them those HR services that they definitely need, the safety services they need, along with the workers' comp savings.
No, that's great. Okay, good points there too. So, and then talk a little bit about the fact of the sort of the before and after picture of what the client's going to get. Like they've been on their own with a BWC Direct. You're going to come in, most the ones I've quoted and we've sold, we're saving the client 10 to 30% against the BWC. So that's been
Right.
great. So they get a savings, but then they do, like you said, they're getting us some suite of services without having to untangle a payroll service that they like. So kind of talk about how the claims reporting works today versus claims reporting under ACS.
Yeah, because in today's world, the employer actually has to deal with three different entities generally for their workers' compensation. They have the BWC, the Bureau of Workers' Compensation, the ones that are actually making the decisions and they're paying the indemnity. But the BWC, a number of years back, probably 20 years ago now, 30 years ago, switched over to an MCO model. So, Mr. Employer, not only do you have the BWC, but you have to choose an MCO who technically works for the Bureau. And so the MCO and the Bureau manage those claims for the under the state system.
MCO Medical Care Organization?
Medical care organizations. It's your Corvells, your Gen X's, Sedgwicks, those kinds, okay? And so they actually do the medical management of the claims on behalf of the Bureau. And the problem is that then, since those two entities are managing it, and by law, they have to err on the side of the injured worker. That means, Mr. Employer, you need to go out and get a third-party administrator to help you defend you against the BWC's decisions. So now you have three people you got to talk to in managing claims. and none of them have a financial stake in managing your claims well. None of them have, they actually make more money if the claims are mishandled. They make more money if the claims go awry. So our model is you have one person you're talking to. We have a claims team that works on the claim. So the claim gets sent into our claims team. We're self-insured. The clients aren't self-insured. We are. We're taking all the risk. And so when the claim occurs, they have a packet just like they have now. Instead of sending it to one of these MCOs or the BBC, those claims get sent to our claims team. Our claims team then takes a look at it and discusses the claim with the client. The client says, I want this denied or I want this allowed. We can process it accordingly. All right. Whereas in the BWC system, if you say, I want this claim denied, the BWC says, yeah, that's your opinion. We're going to allow it anyway. And the claim then has to be, then they have to fight the claim. Now, I can deny the claim too. And in both cases now, they have to go to what's called the Industrial Commission in Ohio. That is the adjudication branch. So that's the ones that determine by law whether this claim should or shouldn't be allowed. So we're still judged against that. All right. So we have to apply the laws as they're written, and we have to administrate the claims as fairly as we can. And if there's a dispute, we go into the Industrial Commission, just like the employer would have to go within the BWC's decision. Now, the big subtle difference is when you're with the BWC and you say, I want it denied, and they still allow it, and you go into hearing, you're having to prove that it didn't happen. The burden of proof is on you. In our world, since you said you want it denied, we deny it. We go into hearing. Now the burden of proof is switched. Now the injured worker has to prove that the claim did occur. Okay. Now that subtle difference makes a world of difference when you get in the hearing rooms. That subtle difference. Now, yeah, we're going to lose. Probably everybody knows you always lose in workers' comp anyway. But it does allow us to get an advantage that we get the hearing officer at least giving some consideration to denying the claim. And a lot of the times we do end up winning those because we have a very solid case about why. So that's one of the subtle differences. Now, the other and the biggest difference is you now have a true partner with me. Why? Because the claims are mine. I'm paying those claims. Right. And so the only way I make money is I have to manage those claims more efficiently than the state did. I have to process these claims faster and better. And you got a true partner now. I have a financial, stake in the game here. Those three entities, BWC, the MCO, and the TPA, they really don't have any financial skin in the game. I do. And so that becomes a huge difference for these employers that we deal with. They like the fact that we're going to be aggressive but fair, and we're going to try and get the claim costs down as best we can.
No, that's great. And then, for those that may have a concern about the self-insured piece, because that's sort of a unique arrangement, in a way, talk about how you had to get approved by the BWC to be self-insured, the financial strength, plus the fact that you guys actually, had programs in your temporary staffing divisions before this, and your
Right.
prior PEO experience too, to give a little credibility, info on that.
Oh, sure. We actually we're actually part of the family of Riley Decker companies, and Riley Decker actually got self-insured with their staffing agency back, I think around 2012. And to get that, we had to go in and you have to submit a bunch of information, but it really comes down to financial strength. We have to show that we're financially sound enough to be able to manage and pay these claims. And so every year we have to renew that. So every year we have to provide them with our financials. We have to provide them with our claim history as well as an actuarial study. And state looks at that and does an analysis on that and says, yeah, you guys are financially sound enough. We're going to make sure that you get renewed. But if we weren't financially sound enough, they would come back and they would actually ask us to put up letters of guarantee. So that's how the protection is. All right. So we have to guarantee those losses. And if we're financially sound, we don't have to put anything up. But if we're wavering on that, we may have to put up 1 or 2 or 3 times actuarial number as far as a letter of credit. Now, a lot of employers might, clients we talked with ask the question, well, what happens if something were to happen to our company and we'd go under or something along the lines? Nothing. The clients have no financial responsibility for those claims whatsoever. whether we're here or not. If something were to happen, all our claims get shoveled off to what's called the guarantee fund. That is a pool that the self-insured community in Ohio pays those claims. So any bankrupt company, and believe me, there's been many that have defaulted on claims, that goes to the guarantee fund. And part of our assessments every year that we pay to the state for the privilege of being self-insured goes to help pay for those claims under the bankrupt companies. So it's a community where, self-insureds pay for self-insureds. And so if anything happened to us, the worst thing that would happen to the client is they would have to go back into the state fund at their higher rates.
Got it. Yeah, that makes sense. It's very similar of a model, as you know, to the other states in the country that have an insolvency fund for the traditional carrier.
Yeah.
So, even a non-rated carrier, if they're admitted, obviously, for workers' comp, is going to have all claims paid by these insolvency funds.
Yeah.
So that sort of relieves that. And the nice thing is that you're self-insured with the BWC. So they're going to go from technically their own policy with the BWC over to your self-insured policy on the date that everyone chooses. They can switch anytime too, right? And
Yes, at
there's
any
no
point in
penalty.
time.
There's no penalty.
No penalty. They basically come out. So, a lot of employers like to jump into with us right before they have to make one of their upcoming prospective payments. And if anybody understands Ohio a little bit, Ohio is on a prospective payment schedule. So it's either a full year or 6 month, or most people go bi-monthly. So every 2 months they have to put up 1/6 of their entire estimated premium for this coming year. And so for some employers, that means, okay, I'm writing a $20, $30, or $40,000 check to cover the claims or to cover my payroll for the next 2 months. And then in July, I get to reconcile that with a true up. Well, that's the advantage to what our program is that we do as a pay as you go. So as the employers, process their payroll, they have our rates, they remit that to us. So it's instantaneously, actually it's in the rears. We're collecting premium after you incurred the payroll. So it actually is a cash flow advantage for employers because I don't have to put that money up front. And you're putting true premium in there as opposed to an estimated premium, which at the end of the year, either you end up going owe more or you're going to end up owing less and you get money back. Either way, it's not a good business model, because unless you're somebody who's really on top of it, okay, I'm going higher than was estimated, which means I need to keep setting money aside because I might have to write a $50,000 check in July. Well,
right. And I've heard clients hate that true up part in the BW because of the way you describe the installments is so sporadic. At least in the world of normal insurance, you might get a 1/12 payment, and it sort of stays somewhat consistent. You don't have these gyrations the way the BWC bills it.
Right. I mean, most people aren't necessarily complaining about the rates. It's the fact that, oh, geez, I got to remember that I'm going to owe extra money come July, or, how come I gave the BWC this loan? Now they have to pay me money back. Same thing with the IRS. No one a wise person once told me, you don't want to get a refund from the IRS because basically what you did is you gave them a loan. You gave them your money to hold on to until you file your tax return. Same thing with the BWC. If your payroll is going to be lower than anticipated, you're giving them a loan until they give the money back to you. That's where we're much more of an advantage because it's the true costs as you go throughout your year.
Right, as earned, yeah. And the cool thing now, like, I don't know, 10 years ago, you didn't see a lot of pay-as-you-go billing options with the traditional carriers. Now, because of some technology tools that are created and some extra third parties, even some folks you just talked to, they're making it easier, to integrate with pay-as-you-go type billing. And I think the carriers got sick of chasing money at audits anyway. So it helps.
It just makes if the technology is there and you can do it, it just makes more sense because it's the true cost of business. Because people want to work on building their business, not trying to track, hey, did I pay this? Did I pay enough? Did I not pay enough? And then have those surprises at the end of the period. And
right.
So, I think that's a big advantage.
And so talk about the specifics one time type. As an example, the clients with ADP, they report their payroll for the week. And then because you're going to get access with a written permission form to access their data at the like a CPA portal, if you will.
Yes.
You can't change or do anything. You just can take data and reports of
Right.
payroll by class, right? And then
Right. Yeah. They all give us access, and most of the big ones have the similar portals. So we go in and we extract out the payroll, and then we're able to take a look and say, okay, this is. And then we do the calculation and we send them an invoice, and then either ACH or whatever means we negotiate as far as how they're going to pay us. And so and that's worked out very well for all our clients, because also in the traditional model, when you're talking about stuff that's not Ohio, the employer has to go and they have to send down an entire report down to the insurance company and say, well, here was my payroll this month, here's the employees and all that information. And so it becomes a hassle. So we've tried to take that hassle away by saying, we'll do it ourselves. Just give us permission, we'll do it ourselves. You really don't have to do anything other than verify our invoice and then pay us.
perfect. And it's just automatically debited, hopefully. And then um so that's really a huge advantage. You get pay as earned, pay as you go. And then as far as the mechanics, okay. So do the client keep their own workers' comp policy with the BWC, a policy number with the
Yes.
BWC? How does that work?
Yes, they must maintain their policy with the BWC. Now, what will happen is when they jump on board with us, let's say they jump on board 1/1, all right? The BWC's fiscal year is 7/1 through 6/30 the following year. So they work on 7/1 through 6/30. So for the 6 months from 7/1 to 1/1, they'll have to do their true up one last time come that next July. They'll do their true up, right? But then there will only be a $120 bill that they'll have to pay to maintain the policy open. After that, as long as they stay with us, we actually go in every year and we actually pay the 120 on their behalf, and to make sure that those policies stay active, because they have to be able to participate with us. But that policy is there because the BWC wants that safeguard that should, once again, if the bad event happened that we were gone, those policies are still in effect. Those employees would still be covered one way or another. So,
Right. And then all that history, let's say from that period they switched from January over to you guys, that stays then with the BWC policy they have, right?
correct.
And
Yes.
then would they need to continue probably keeping in place the MCO, the TPAs, and so on?
They won't need the TPA necessarily. Now that's something they need to decide about. Obviously, I don't want them to feel like they're being trapped, because I do want those old claims to be continued to be monitored, because what I don't want to have happen is those claims go awry, their EMR skyrockets inside the state, and then they feel like, well, I have no place to go. I'm trapped with you guys. So we always recommend either keep it or let our TPA take over the claims. Let our people manage the claims. But those claims still need to be managed. The MCO still needs to pay the bills and all those things, but they no longer are paying the bureau. Okay, and so after that, though, everything is handled by us.
All
After
new
that,
claims, of course, will be under you. So
right?
you're saying that technically that the client, if they want to use you and your TPA for their old claims, they could somehow do that?
Yes. Now that becomes a cost advantage. Now it's just not the workers' comp savings. Yes, the premium savings, but right now they're probably paying that TPA. Well, you no longer have to pay that TPA. And if they're participating in one of the kind of group programs, either Experience Group or Group Retro in Ohio, they're probably paying a sponsor organization a fee in order to access those discounts through those groups. So that can go away. And so all of a sudden the TPA goes away. The group sponsorships that they're paying to get those discounts go away. The legal expense, because in defending those claims, they're probably engaging from time to time an attorney. Okay, that goes away. So there's actually more cost savings when it comes to the workers' comp than is just the premium. It's all the backside. It's all the time you're spending in managing those claims. We've had a number of clients sit there and say, once they get into us, it becomes so much simpler that they're not spending nearly as much time managing those claims or having to stay on top of it, because they know we are. Because once again, going back to it, the only way I make money is I have to bring those claims in better than what the state did.
Hey everybody, it's Eric. I just want to pop in for a quick announcement. Exciting news. I just launched my new book on Amazon. It's called The Blueprint: An Insurance Agency's Unconventional Rise to the Top. And it goes through a little bit about how I built the agency Insured Solutions since 2009 to today. And the blueprint in terms of how I actually did it with the tech stack, the offshore, nearshore talent, and digital marketing techniques that I use. So pick up a copy today on Amazon. Thanks, guys. Got you. Got you. So you're saying they don't have to pay an additional fee for you to help manage those past claims then to these TPAs?
Typically, no. Typically, if we have that conversation, it just gets rolled into the number. And since we're managing the claims from us going forward, it also behooves us to manage the old ones as well. And so it becomes efficiency so
Okay.
that, because obviously a lot of times you have people with multiple claims. So we kind of like to engage from that perspective because, that gives us a better sense of the history and be able to work with this client. Our ultimate goal is to reduce their workers' comp costs down. Okay. And we've reduced for some clients so much they were eligible for the maximum discounts within the state. Well, they liked our system so much better. Like, why would I go back and do that again? When this has worked so well that it's brought me to this point. And so we've had a lot of clients realize, yeah, they probably could get a little bit better rates if they would jump back into the state, but they knew they weren't get the service, and therefore eventually their rates are going to go back up anyway, and therefore then they become. So it's like let the system that's working keep working for them.
Got you. And then what kind of businesses are like ideal candidates and the kind of size of the premium and number of employees would you say is the best fit for this kind of program?
Well, this is what's going to be unusual that a lot of your listeners are going to think is counterintuitive, but it's not. In the traditional insurances, a lot of people don't. They say, they don't like to insure certain things. We don't insure roofers. We don't insure, mining. We don't insure, scaffolding crews. But that's also where the premium is. And so our ideal is it's not necessarily an industry, although we do prefer, we're heavy into transportation. We've always been heavy in nursing homes, ambulance companies, but it's really employers that are paying probably $40,000 or $50,000 or more in premiums. And that's kind of where we're at. Our ideal candidate is that guy who just had that one bad claim. That 1 in a million claim just came in. It's now starting to affect his rates. His rates are skyrocketing. And he's like, oh my God, what am I going to do? And we're able to come in and say, okay, did you make changes? He says, well, I don't even have that piece of equipment anymore. We're not even doing that anymore. The state can't adjust rates based upon that. I can. I can take a look at that and say, oh, okay, you've done X, Y, and Z. So now that's not going to reoccur. So I'm going to go look at the rest of your history and say, okay, what am I really looking at? And I can give you a rate accordingly. We had this conversation with a prospect 2 days ago, and they had horrible years, but and unlike a lot of insurances, I actually look back about 6 to 8 years back. I don't look at just 5. I try and look back as far as I can. And, back in like 18, 19, 20, and maybe a little bit in 21, they had $500,000 years, $400,000 years, $300,000 years. But then all of a sudden something switched, and all of a sudden it was like 150, 200, 160, 30,000, 40,000. And so when we actually had our interview with them and we're going through and we called our safety call, I said, okay, guys, can you tell me kind of what's going on, what's changed and what's going on? And through our discussion, all of a sudden I find out they didn't have a safety director until 4 years ago, 5 years ago. All right. All of a sudden the safety director came in and started saying, well, we introduced these behavioral training programs. We introduced these other things. All of a sudden I'm like, oh, I see okay, that's what they've done. So now they're still kind of living with some of the sins of the past, but I'm able to come and say, you've done the work to make the changes. I can get you to where you probably really should be quicker. And so that's like a success story. That's what we look for, is the people who sit there and say, we know what we were doing wrong. We fixed it. Why do we have to suffer for 4 years with this one bad mistake? And we're able to come and say, you don't. Prove to me that you've made those changes. Now, okay, great. I'll give you a rate that's more indicative of what you're like today, not living with the sins of yesterday.
No, that's great. You have some margin room because of the self-insured piece, your pricing can adjust to what the client's losses look like, in terms
Right.
of what you're going to do as an offer on that, and then show a comparison. Here's where you are now with the BWC, and then here's what, under the ACS AEO model, right?
Right. Because the BWC is making you pay for your sins of the past. All right. You had bad claims, they're jacking your rate because you really, it's the idea that the BWC set it up to be like that's a predictor of your attitude going forward or your performance going forward. Well, that's not always really the case. And this is that's a great example. Like, yeah, that was their sins, but they've changed. All right. Now you're not going to have that same amount of cost. And so the BWC has always, has said we're collecting premiums to pay for the claims inside this year, inside this fiscal year. All right. And it's only supposed to be for the claims for that fiscal year. But that's not really what it is. It's a punishment going forward because now you're going to be paying for the next 4 years, even though your claims aren't that level. And that's where we become successful. Are we a good fit for everyone? No. There's a lot of employers out there we're not good fit for your office people, your accounting firms, your lawyer. The premium's just not high enough.
Right. So
Because
blue collar, construction, transportation, manufacturing, home health care, like you said, nursing homes.
Follow the premium.
Yeah.
And if you imagine, if we're self-insuring somebody, if we're taking a risk, we want a pretty good chance for a good reward. And that means it's got to be a high premium, And so, the biggest premium we ever had in our old days was we had one client that was paying us almost $4 million a year, but their claims were only averaging about 1.5 million a year. So that's the old days. State's not like that anymore. The state is now on going on a 30-year run of dropping rates, and the state of Ohio has in the top 5 of lowest rates inside the country. And so that's why it's really hard for us to find that sweet spot anymore, just because the rates are so competitive. But they're still out there. There's still a lot of employers, and you and I deal with a bunch of them when it comes to these Amazon delivery guys. These guys are basically 3 or 4 or 5 years old. All of a sudden now these companies are starting to see the fruits of their losses coming in, and their rates are starting to go up, and they're like, oh my God, what am I going to do? No one really told them, listen, you're living in a fantasy land for these first couple of years. First 2 years in Ohio, you get max discount because they don't start looking at your claims until year 3. And so all of a sudden now you had artificially low rates, to be honest. And so now they're starting to get those rates jacked up. All of a sudden they're like, I don't know what to do, but the rates are going so high that they're not really indicative of what their true loss potential
Yeah,
is.
I'm glad you brought that up because we had an agent brought in a few accounts that you remember, and they were coming up on their 3rd year in about, I don't know, 4 or 5 months. So it wasn't the right time now because, like you said, they're getting these max discounts that are incredible, but
Right.
their rates are really going to go to reality land on that year 3. So we'll help if you send a submission in, we'll help you gauge that timing if that client's only been around a couple of years, right? 2.5 years.
Right.
Okay.
Right. And that's where a lot of the agents might sit there and say, their clients come to them because all of a sudden now they're panicked. All of a sudden, I didn't realize my rate was going to jump this high. What can I do? We're now that solution. Oh, we've got a solution for you. We're not going to be able to keep the rates you had, but it's not going to be as bad as what you're looking at.
And that's an automatic jump, whether they have bad losses or not, right? They're going to get pretty much what would you say as far as a percentage of an increase on year 3 coming on?
On year 3, I mean, when you're talking about somebody who's jumping in there, I've seen as much as a 200% increase through the state. I've literally seen people go from paying $30,000 or $40,000, be looking at $400,000 or $500,000 the next year.
Is that because of losses then, or?
That's because of the losses, but also they're not fully matured yet. Now they have just 1 year coming into the experience. And so they might have a big loss in that year, and they don't have a lot of expected losses to go against it. And all of a sudden, the way the math works, all of a sudden they're seeing that jump. They go from being in a group at an artificially discounted rate at a max discount of a 0.57 mod, and now all of a sudden they're going to a 1, so that's a doubling, or worse.
Okay. And then let's talk about how to get a quote. I've been doing this in work comp game a while, and like getting the accord and the loss runs and supplementals and things like that are like a norm for all of us agents. So talk about the AC3 form.
Yeah, it's in Ohio. The advantage we've got is the state's holding all that information, all that data for the state funders. And so, we have what's called, it's the state form. It says an AC3. We just need that completed out. Give us the policy number for the entity you want us to look at, the address and the name of the company, have them sign it. All right. Send it to us. The state of Ohio works on a system where I can only request data by noon on Thursdays. Okay. And then I would have the data back sometime over that next weekend, generally on Friday, but not always. Sometimes it might go to Saturday or Sunday before I get the data back, right?
Okay.
At that point in time, we then start evaluating that either really late on Friday or Mondays when I start really looking into saying, okay, let's take a look at these and see which ones work and which ones don't. It's that simple. Now, the only caveat is if you're bringing us a prospect that is already participating with a PEO or another AEO, the data's not there. So now we've got to go back and we got to do old school. You got to go get me 5 years worth of losses, 5 years worth of payroll.
Got it. Yeah, we ran into a few of those, I remember. So it went back to the old days, but majority of the time, because most people are just with the BWC directly, that one-page form is just a beautiful thing, you know, to get a
Yeah.
quote back. And then again, we talked about the fact that they can switch anytime, no penalty, kind of similar to
Right.
the assigned risk arrangement typically, you know, there. So that's nice not to have a short rate penalty, you know, during the year on a
Well,
schedule.
there's also another little because we talked about kind of like the ideal candidates, but there's when you talk about construction guys, there's another advantage that's really good in the construction industry. A lot of those guys have to have a one mod or better in order to even bid on certain jobs. Right. So you have that guy who's got a mod that's above a one. Well, if they come to us, they then get our mod. Now, there's not an official mod for a self-insured, but we do go through and we do the calculations. We calculate what our mod is, and our mod's always below a one. So then we have letters that we can send to those construction guys that give this to the general or whoever you're bidding with, and it's going to tell them they're participating with us. Our mod is this, so therefore that's their mod currently, and therefore it's I've never had it rejected. And that's an advantage because then I've got a number of construction guys that stay with us just because they're like, I can't play around with the mods, the possibility of getting a high mod, so they stick with us. The other
So
advantage
on that
is
note, what about the current mod under the BWC, you know, policy? Does that somehow change? Does it say go down to the one at some point over time with no claims being reported to it, or how does that work?
exactly what happens, and then it goes to what's called merit rated, the one mod, the non-existent claim. So as their claims start to drop off, their mod inside the state will react accordingly. Now, should they leave us, the data that we have, the BWC is going to ask for. And so they're going to take those claims, they're going to take that payroll, and they're going to develop a mod based upon the history with us. All right. Obviously, everybody can understand that. That's just good insurance practice of saying, listen, there's a history out there. We need to know what it is so we can appropriately, rate these guys and give them proper premiums.
And then let's say they, you know, they did leave, they went down to the 1.0 mod, then you provide that data over to BWC, they calc a new mod based on that information. And so what's the timing of all that usually like, you know?
That depends upon the time of the year and how many. I mean, obviously, a 1-1 and a 7-1, there's a lot of ins and outs. So that recalculation could take some time. If it's sometime between February and May, it might happen a little faster, just because it's the bogging down the state.
Okay. And
So
like, what about so going forward, they're not with you anymore. 3 or 4 months later, they want to get an updated loss history. Can then the BWC provide with the time they were with you and the time now the time they've been with the BWC and kind of they go to the BWC to get all of that info?
yeah, they have to. It's called a data request. They would have to send it into public records and say, hey, provide us with the information that you're looking at to develop this mod. But quite honestly, it's generally not that it's not that difficult to go back to the prior PEO or prior AEO to get the data. I mean, by rule, we have to provide it. If requested, we have to give it. And so if the client comes back to me a year later and says, I need your data for this, I have to give it. I have to give it within 30 days or I can get penalized.
Okay, but you is that the process though? Like when they leave, if they were to leave you, they would have to ask you for it, or can the BWC grab
The
it?
BWC asked me for it.
Oh, they ask you for it.
Oh
Okay.
yeah, and I'm required to provide it.
Okay, I got
Actually,
you. I got
actually,
you.
they don't even ask. I'm just required to provide it. I know they have to have it, so I have to send it anyway. Which is
Yes.
so, so 9:30 when they get ready to do their snapshot for the upcoming year, I have to provide all new data for all the clients that have left us, that kind of stuff. But it's not that big of a hassle for us because we don't lose clients, so
Okay,
I
yeah,
really
high
don't have to do it
retention.
all that often.
Yeah. And is it just last question on the exiting, because I just know agents don't like to know like how far they're locked into this thing. So can they just leave with a 30-day notice?
Yes.
Okay.
Yep. We're not one of those that sit there and try and handcuff and try and penalize or put fees on it. If you don't like working with us, you know, we you know, we don't want to keep people. We don't want to trap people, And so we've never been that way. It's if you want to go, fine. All right.
Gotcha. And now I've been talking to some other agents that are like in Michigan and Pennsylvania who have clients in Ohio. Talk about are you going to add some multi-state coverage, on top of what you're doing in Ohio?
We are in the process of finalizing those details. We have a target date. I'm not comfortable releasing that target date now, but it is fairly soon. We are putting, with your help, by the way, we are putting some things in place to be able to kind of go live in a relatively short period of time. But it is going to be it's going to be an all states policy, and in which we want to service because we're doing it because we have a number of clients in Ohio that are in certain industries like trucking and construction stuff where they do periodically have to go outside Ohio and they're doing work outside. And to be able to sit there and say, we can universally cover you. We just have to make sure we declare it through the insurance companies and get everything put in place. But it's going to become a real advantage because what we want to do is stop putting the situation in place where we have an Ohio employer who happened to run somebody in Michigan, and just by happenstance, the guy actually lives in Michigan, and therefore then Michigan comes back and says, nope, that's a Michigan claim. Oh, by the way, you don't have the proper coverage, and we're going to penalize you on top of it. So what we're trying to do is put the situation to where, we're jurisdictionally covered for the current clients we've got that are in those situations, and start going out and actually soliciting companies, in Kentucky and Indiana, all over the country.
Yeah, yeah. I know the agent's going to like it because, they can kind of wrap it all in one program versus having, let's say, a Travelers, Hartford, Byberg, whatever for the other states. And then you got Ohio with you. We got all these different things where you can manage this whole, pay-as-you-go reporting model on
Right.
behalf of the client in multiple states with the,
Right. My partners and I mean, we're fairly good at HR. We're fairly good at unemployment and FMLA and some benefit stuff but we're really good at workers' comp. And that's kind of our specialty. And that's where we're like, we've made special arrangements. We've got an insurance company that's kind of taking a flyer. And they're like, we've worked with you guys in the past. You've been successful every time you started something. We're going to get you this program and kind of let you see how it's going to go. And it'll be a fully insured plan if the client wants that. If the client wants to put some skin in the game, we're going to have deductible options to where they can pay the first part, first X percent of a claim or up to a certain dollar level. We're going to have several different options to make it enticing for companies to come and work with us.
that makes sense. P&C agents, have you run into Byberg, which is a Berkshire Hathaway company quoting workers' comp for either your prospects or clients? Well, great news. Insured Solutions, a national MGA, has an appointment that is set up to allow you to quote, bind, and service Byberg at your agency. And the coverage is in all states. It's A-rated. Startups are even accepted. There's $125,000 maximum premium. And some of the tough industries they write are construction, transportation that includes towing and parcel delivery, manufacturing, security guards that are armed and unarmed, motor mediation, and many more. So go to our website at insuredsolutions.net, click the Get Appointed link. We'll get you logins for you and your team and can set up a webinar for training if you'd like. Also, feel free to email info@insuredsolutions.net and I can handle the submission myself, or call 770-402-5343. Be glad to speak to you and give you more detail. Thanks. And then with your help, I put together some things for the agents, since it's a relatively new program, to help them in the marketing. Because like what happened with already is that I had some agents I was working with that actually out of Michigan who were selling Amazon business like nationwide, as an example, and writing the auto and the GL umbrella, and the property, and then they were also writing those kind of accounts in Ohio. So when they found out they could handle the work comp, now they're tying everything together and just sort of rounding out the account for that. So the what I've done is created like a letter or that you could send to your current client base and ask them if they have premiums over 50,000 a year or over 4,200 bucks a month in premium or so, that they pay the BWC now. If yes, then you'll also attach the AC3 form in your email, and they just fill that one form out. But it kind of outlines the program to the client, that there's going to be this 10 to 20% savings, pay as you go, switch anytime. So worth taking a look. And then if you're the agent, you just get that form back to me, just at eric.stein@insuredsolutions.net. And we'll get that over to ACS for you and get everything all quoted. Then the agents can now take a look at the quote comparison that you're going to provide, and then from there decide if they want to make a presentation. I can be on with them to do that, the agents. We can also, I've had ACS come in a lot of times as well for the larger premium accounts, to just answer all these detailed questions like Bob knows about the work comp world there, too. So that's how that works. And then we've got some brochure packages that are good for training with the agents in the office. We've already had a webinar that you were just on, Bob, and I appreciated that, that we have that I can send out for training purposes as too. So shoot me a note at, again, eric.stein@insuredsolutions.net, and I'll hook you up with everything you need. And we can also do a call together with you and your team to go through it. Bob's happy to help on that too, once you get settled up in on that piece. But it's going to be exciting, I think, especially when we start adding the other states' coverage to this. But then, Ohio is going to be phenomenal, and just, focus on your existing book right now. And then, of course, new prospects. But the existing book is like, why not pick up an extra, basically a 5% commission where you're making zero on it now on the workers' comp. And especially if the premiums are larger than that, the ones we've been writing, and some of this transportation is over 200,000 bucks. We're saving the clients 20, 30, $40,000 a year. They love you for it. And it's the same exact, technically the same paper, if you want to call it that, that's with the Bureau Workers' Comp. And it's just, instead of going to direct to the BWC, you're going to the ACS's self-insured package. So it's been pretty hot. It's like kind of been fun learning this with you guys, because I've been doing the work comp stuff for 20 plus years, and it's kind of getting stale, but now it's like almost a whole new product to learn.
Well, it's a whole new world. You're able to enter in something that you really, people didn't really want to push group rating, and the fee. I mean, the fees on that were so low, and the commissions on that were so low. It's a totally new world when you're talking about what we're doing here, because now it's a percent of the premium that we're able to collect, and that's something you haven't been able to touch. And it may only be maybe 5%, but it's 5% on top of a large number that you never got to tap into anything on before. Matter of fact, you had to tell your client, there's nothing I can do to help you. I mean, just a pure fact that now you can say, I can help you in Ohio. I can do something. We've got an option. Let's take a look at it, and it might work, and it might be the thing that saves you, 20 or 30 or 40 or $50,000, and change that year for you.
Absolutely. And the agents I've spoken to already, after that webinar, we got a lot of influx, and they're pretty excited about it. They're starting to get their systems in place now to identify those clients with the larger premiums. Also, another thing would be in the construction area, blue collar area, transportation area. Would you say, Bob, like what, 35, 40 employees would probably hit that, plus would hit that 50K premium?
Generally, but as everybody knows, when you talk about workers' comp, you talk about the trade. A roofer, yeah, 35, 40, probably there. If you're talking about an electrician, Electricians probably got to be 50, 60, maybe 70 employees because rates are just different with electricians than when we talk about plumbing and HVAC guys. And so it just depends. But we like the hard guy, the guys who are digging trenches, the guys who are laying concrete. Those guys are paying some pretty good premium, and fairly easily we can sniff out whether that company's been lucky or they got a real good safety program.
Gotcha. And can you assist with some safety services as well if they need it?
Yes, we do have that. And so if they do need it, we've got access. Our partner in this, our TPA partner, has a full range of safety services that is part of the fee that's being paid.
Makes sense. Makes sense. And then I know, well, we haven't designed it yet, but I think our goal is to do a webinar in a few months, a couple of months, like Ohio Workers Comp 101. We kind of went into half of it on this on this discussion, but I think that'll be something that agents have already asked, like, hey man, I've never sold workers comp, in Ohio, so I don't even know how it works. Can you help?
Yeah.
So I think that'd be something that would be pretty beneficial, don't you?
Yeah, that's one of the things. Unfortunately, it's the thing I geek out about is talking about it, and I think I've told you, and I bring this up a lot of times. I was told I picked up a piece of philosophy a long time ago, saying the best thing you can do is if you really want to make some good money is go and find out what everybody hates doing, and then become the best at it. And when my first couple jobs with Coca-Cola and Pacific Dunlop and Bristol Myers Squibb, all these corporate guys hated Ohio Work Comp, and I'm like, if I come really good at it, people will pay me a lot of money. And it kind of worked.
That's great, man. Well, I appreciate it, Bob. Anything else you want to say at the end here, or do we cover it?
No, I appreciate your time. I appreciate trying to, getting our message out there. And, we look forward to working with all these producers and agents and trying to bring some savings and some relief to their clients.
Oh yeah, it gives them a chance to make some extra commission and just sort of lock down the account. It keeps, other agents who are now going to be selling this service out of their accounts, because they've been making quite a good money on the package line. So I think having this to vaccinate against someone else coming in and either offering a similar service or there's a few companies that are doing this and selling direct and not through agents at all. So,
Right.
this will just help keep things under the umbrella of the agency and kind of wrap up the account.
Yep. Sounds
Perfect.
good.
Well, I
All right.
appreciate it, Bob. Thanks for being on, man. I do appreciate it. And I'm going to see you in September, hopefully, as well.
Yep. Will do.
Thanks again for tuning in to Insurance Shop Talk. If you enjoyed our deep dive into the latest trends, please don't forget to like, subscribe, and hit the notification bell so you never miss an episode. Until next time, I'm Eric Stein, and this has been Insurance Shop Talk.